everybody, and thank you for joining us today for PKS Preparing for the Financial Year FY 22-23 seminar. My name is Joseph Archer, and I'm a Business Service Partner at PKF. Before I introduce our speakers, I would like to cover off a few housekeeping points. Firstly, if you have any questions during the webinar, you can submit them through the Q&A widget or through the chat function. We will try and answer as many as possible of these throughout the webinar, but if your question needs a fuller answer or we run out of time, we will get back to you later via email. Please know that we do capture all questions and we do read them. And secondly, an on-demand version of the webcast will be available tomorrow and can be accessed using the same audience link that was sent to you earlier. So now to our speakers. First, you've got myself, Joseph Archer, again, one of the business services partners I've already mentioned. We have Dave Thompson, another partner in our business service team as well, and Taka Saburi, one of our lead assistant managers who has recently just returned to business services from quite a long stint in our technical department. So in terms of what we'll be covering today, David will be providing with an update on the new standards and amendments to some of the standards and legislative changes that will be applicable for the coming reporting season. Taku and Dave will also be providing you with a good update in relation to the FRC's findings from their annual review of corporate reporting, and also providing with an update to some of those common errors that have been being seen in financial statements, and therefore that you would need to be aware of prior to launching your preparation of your FY22 accounts. And finally, I'll be providing an update on the general ESG environment, who's falling into scope and what needs to be done to make sure that you have the tools ready to get ready for the changes that are afoot on there. So I will now pass you over to Dave for his update on the new standards.
Great, thank you, Joseph. Good morning, everyone. I'm going to just spend a little bit of time on the new standards, amendments to standards, and any legislative changes. So the good news, next slide, please, Jenna. The good news is that it's been a period of relative calm. We're going to start with IFRS, then move on to FRS 102. As I'm sure you're all aware, there's been very little in the way of new IFRS standards. The one that is on the horizon, taken the best part, I'm told, by my financial services colleagues, that's taken the best part of 20 years to get to this point. It is very specific to insurance contracts. That's IFRS 17. I don't propose to cover it in any detail this morning. Please speak to, if it does impact you, please speak to one of our partners in the financial services division. They're significantly more knowledgeable than myself, but that one comes in from periods commencing on the 1st of January 2023. But obviously a lot of work is happening at the moment in the comparative year and the transition date, which is 1st of January 22. Next slide, please, Jenna. So as I mentioned, very little in the way of new standards. Nothing's come out since IFRS 16. As always, though, on an annual basis, there are what we call the amendments to the standards by the regulators. I will say at the start that some of these are quite specific, quite niche to particular circumstances. Normally these arise where companies and or audit firms come across a particular problem that's not covered by a standard. They feed it back to the regulators, who subsequently issue an amendment to the standards. But these are fairly light touch and, like I say, specific to particular circumstances. So the first one here, business combinations, which is IFRS 3. This is looking at acquisitions of subsidiaries but also business asset acquisitions. So it's now referable back to the 2018 conceptual framework. You won't see or notice much difference from there. As I'm sure you're aware, on any acquisition, you're required to look at the fair value of the assets and liabilities acquired at the acquisition date. So this amendment really brings in looking at provisions, contingent liabilities, contingent assets, And unsurprisingly, that's all referable back to IAS 37 in respect of provisions. IFRIC 21 levies, that's a very specific standard that won't apply more widely. And then the final point there, which I think we're all very familiar with and have been applying for a number of years, is that you don't recognise contingent assets acquired in a business combination. Next slide, please, Jenna. This one, again, very specific. This is IAS 16, property, plant and equipment. And this is all to do with the receipt of proceeds before intended use. So this could be an asset in the course of construction or an asset that's being tested. Often that does generate some revenues, some proceeds. Previously, people were deducting those proceeds from the cost of the PPE, almost as a contribution to the cost. But that's now been changed under this amendment, and basically proceeds from sale just go through revenue and cost of sales, similar to how they would do once the asset is brought into use. So fairly limited scope on the IAS 16 amendments. Next slide, please. IAS 37 came up a second ago. Provisions, contingent liabilities, contingent assets. Again, quite specific, but probably in the current economic environment, potentially more relevant now to contracts, long-term contracts, ongoing contracts. And this is really assessing those contracts for those that are loss-making. And it's really clarifying the types of costs that you need to bring into that assessment when calculating whether a loss-making onerous contract needs to be provided for. So it's fairly familiar in terms of what you would expect to bring in. So those costs that relate directly to the contract, I think that's fairly familiar. The second point is really the issue here is that you're looking for costs that could be allocated to the contract in terms of fulfilling that contract in the future. So that could be depreciation, other overheads. So those also need to be brought in when assessing a loss-making contract. Next slide, please, Jenna. This one you're probably familiar, the annual improvements projects. They kind of come in on a rolling basis. So the ones that are applicable to the 1st of January 22 is for the IFRS standards, improvements 2018 to 2020. Again, I'm not going to spend much time here because they are very specific. You can read these later on. Talks about first-time adoption and foreign exchange. Looking at the 10% test under IFRS 9, again, fairly limited scope. IFRS 16 leases, this one does actually come up quite regularly. This is clarifying the treatment of basically contributions received from the lessor as part of should be treated as part of the lease incentives, a bit like rent-free periods. And then the final point there is on biological assets under IAS 41. I don't propose to go into that today. I think that's not applicable to very many people. Next slide, please, Jenna. So moving away from IFRS, as I said at the start, fairly unexciting at the moment, which is not a bad thing. I think the regulators are certainly encouraging people to be comfortable and properly apply the standards that are in place as opposed to introducing new ones. Very similar position with FRS 102. So very little has changed since the initial introduction of FRS 102. The regulators did commit to doing what they call a periodic review at least every 5 years. So we've had one since the introduction of FRS 102. That was back in 2017, and that came in with effect from the 1st of January 19. So everyone will be familiar by now, certainly with the small changes that did come in. The second periodic review, it's a little bit of an uncertain position, to be honest. It commenced in March 21, so it's been going on a significant time now. It hasn't yet been published as a FRED, so the exposure draft. It is expected before the end of the year. We're all slightly hesitant as to what may be in there, given the length of time that it's taken to release and finalize that exposure draft. The good news is that any of the changes don't come in any earlier than the 1st of January 2025, so there is a significant transition period. But what we are expecting, and again, this is to be clarified, is that we're expecting the regulators to bring in certain parts of IFRS 9, IFRS 15 and 16. So that's the financial instruments, revenue recognition and leases, which are currently outside of FRS 102. But we think that parts of some of those standards are expected to be brought into FRS 102 going forward. So a little bit of watch this space. We will update you on that as and when that's released, and we will find out the results. Next slide, please, Jenna. So next section, key findings from the FRC's annual review of corporate reporting. This is really picking up on the areas where the FRC and the corporate reporting review team have picked up companies on when reviewing their financial statements on areas where they will seek improvement. So I'll pass you across to Taku, who will take you through the first few slides in this section.
Thank you, Dave. Next slide, please, Jenna. So the FRC performed 252 reviews as part of its 2021/22 review cycle, compared to 246 in the prior year. And their monitoring work was weighted in favor of the FTSE 350. And they have published the top 10 areas of challenge that they found in their review cycle. And those included cash flow statements, financial instruments, and income taxes, which are the top 3, and we'll look at in detail this morning, as well as strategic report and other Companies Act matters, issues around revenue. Next slide, please, Jenna. And then you have, of course, your provisions and contingencies, alternative performance measures, judgments and estimates, your impairment of assets, and lastly, presentation of financial statements and related disclosures. Next slide, please, Jenna. So in terms of our cash flow statements, the number of errors that they found in this review cycle almost doubled compared with the prior year. And so to help drive the necessary improvements, cash flow statements have been identified as an area of key focus in their upcoming quality inspections of the 2022 and 2023 review cycle. So this is something to take note of. And essentially the issues they identified can be categorized into 3 sections. The first one being classification issues. And the main issues included misclassifications of cash flows as operating activities. So as a reminder to our joiners this morning, cash advances and loans made to other parties or repayments thereof are investing activities and not operating activities, whilst cash proceeds or repayments of borrowings will be under financing activities. There are also errors and issues around the inconsistent application of policies, accounting policies for similar items. For example, where you have interest payments on leases that are classified as cash flows from financing activities, whilst their corresponding interests were classified as operating cash flows. So that was a bit inconsistent. And then the second category is around the reported cash flows. And the main issues in this area included incorrectly including non-cash transactions in the cash flow statements. So an example of this is your additions to right of use assets, which are non-cash items. There were also discrepancies between amounts in the cash flow statements and amounts disclosed elsewhere in the financial statements. For example, where you have your internally generated intangible assets and their corresponding cash outflows. The FRC also found that reconciling items for your reconciliation to cash generated from operations were just not given enough meaningful descriptions or were inappropriately aggregated within other adjustments. So we really need to pinpoint and to include disclosures that are useful for our users so that they are able to really follow through on those reconciliations. And lastly, there were issues around inappropriate netting off of cash flows. For example, where the parent company cash flows are offset with intergroup borrowings and lending cash flows, that's inappropriate. They should be gross. And the last category there is around disclosures. And they found that generally the mandated areas under IAS 7 were just missing, for example, in respect of significant non-cash transactions, for details about the restrictions over cash and cash equivalents, for example, or the disclosures just did not provide enough disaggregation. So this is, for example, around the reconciliation of your financial liabilities from financing activities, where you can separate out movements between lease disposals and lease modifications, for example. And there's some reasons as to why these issues occurred. For example, cash flows are often an afterthought for entities, or there's like the presence of unusual or infrequent transactions, for example, your business combinations, or perhaps it was a misunderstanding of what constituted cash and cash equivalents. Next slide, please, Jenna. In terms of our financial instruments, the FRC asked more questions about financial instruments in their review cycle, and in many of the instances, their queries could have been avoided by clearer accounting policies and disclosures. The FRC mainly raised questions around your disclosures of expected credit loss provisions, so ECLs, and the liquidity risk disclosures, particularly around financing arrangements and covenants. Both of these areas, liquidity disclosures and ECLs, will definitely be an area of focus in view of the current economic climate, and we'll touch on that in the later slides. And there's a myriad of concern areas, and they're categorized into three. For example, there's scope and recognition issues, for example, with your derivatives, how were they accounted for and what specific factors they were included to determine whether non-financial contracts are within the scope of IFRS 9 derivatives, for example, or loans receivable. They challenged the discount rate that was used to determine the fair value of related party receivables, for example, and issues around financial guarantees, where associate lenders were provided financial guarantees, and if so, how those were accounted for. Another key category was the ECL provisioning and the credit risk provided. And the majority of those areas were just around missing information, particularly around the impairment assessment for financial assets other than receivables. So whilst they found that people or entities are quite good at disclosing trade receivable ECL impairment assessments, other matters, for example, contract assets or amounts by group undertakings or related party receivables, there was just not enough information or detail around how the impairment assessment occurred. And there are issues around the credit risk related disclosures. For example, your inputs, the assumptions, or your estimation techniques that you used to apply the IFRS 9 impairment requirements, or the information around the credit risk management practices. And other matters were generally around the improvement of the liquidity disclosures. For example, the maturity analysis for your lease liabilities, especially around the gross contractual cash flows. As a general principle, IFRS 7 requires that an entity has to disclose information that enables the users to evaluate the nature and the extent of the risks that arise from financial instruments, from which the entity is exposed at the end of the reporting period. So often the back end is lacking the level of detail and explanations that are required to meet this overall objective. Next slide, please, Jenna. And in terms of our income taxes, the FRC raised an increased number of queries in respect of accounting for income taxes. And in several instances, it was an issue around boilerplate disclosures, so not specific to the entity, especially around the evidence to support the recognition of deferred tax assets, particularly by entities that have recent losses, despite those areas being a matter of improvement in the prior year annual review cycle. And income taxes will also remain an important area of disclosure in the current economic environment. The following were areas of improvement. It was generally around the evidence of your recognition of deferred tax assets, especially, like I said, for loss-making entities. There were issues around the explanations and the disclosures that were being provided to enable the understanding of the accounting treatment on items like your cash flow hedging instruments or material unrecognized deferred tax assets, particularly where there's a significant deferred tax liability in the balance sheet, or the exposure to your tax-related disputes, including how those were accounted for and the amounts that were recognized. And there are also some issues around the reconciliation between your accounting profit times the applicable tax rate versus the tax expense. So particularly around the completeness of the reconciling items that were provided, given the other disclosures in the annual reports and accounts, or the explanations of the tax rate that was used to calculate those deferred tax assets and liabilities. And the main area is the usefulness of those reconciliation, particularly for group entities where you have subsidiaries that are operating in several jurisdictions. So, and therefore I see noted here that it might be more meaningful to aggregate your reconciliations using a domestic rate in each individual jurisdiction and then disclose the weighted average tax rate applied to your accounting profit. Other issues were mainly around the accounting for nuanced areas, for example, your deferred tax and current tax on share-based payment transactions, or the types of temporary differences that you have on your deferred tax assets or liabilities recognized, and material adjustments in respect of prior periods. So once again, income taxes will remain an important area of disclosure, particularly given the current economic environment, and we'll go into detail around that as well. Next slide, please, Jenna. So to tackle those top three findings, I thought these are quite important points to be considered. And please note that these points are not exhaustive, but they should be a good starting point. So in terms of our income taxes, remember to include the forward-looking assessments, particularly taking into account the difficult economic environment ahead of us. For example, remaining alert to changes in your tax regimes introduced as a response to inflationary increases that we've seen. For material deferred tax assets that you're recognizing this year, ensure that if you're loss-making, the nature of the evidence are supporting that recognition, so your future profits that's included and any significant judgments and the sources of estimation and uncertainty should also be disclosed. Cash flow statements, it's all about consistency between what you disclose. Non-cash items should be excluded in the cash flow statements. Your classifications and your definitions should match the criteria in IAS 7. Ensure that cash flows are not inappropriately netted off where gross amounts should be shown. And where you have a parent entity cash flow statement, ensure that the requirements of the standard in terms of IAS 7 for that statement are also met. In respect of financial instruments, it's all about the nature and extent of your material risk arising from your risk management. Those should be adequately disclosed. Your approach and your significant assumptions, particularly in ECL measurements and the concentration of risks where they are material, those should be disclosed. And other areas around your accounting policies, your default rates that you have used, and any banking covenants, all of that where material, including the effects, should be adequately disclosed. I'll hand over to Dave to speak on key messages on other corporate reporting areas, so the top 4 to 10 on this matter. Next slide, please, Jenna.
Thank you, Taku. So I'll just kind of bring together the messaging. I think overall, as we say, there's very little in the way of new standards, but what the regulators are really looking for is specific disclosures and consideration of the risks and uncertainties in the current environment. So as Taku mentioned earlier, we've got rising inflation, we've got slowing growth and recession, increasing interest rates, supply chain issues, everything else. What the regulators are really looking for this year is for the preparers of the financial statements to consider, given all those business environment factors and their impacts, what the implications are for companies and groups. And this is really looking at those types of areas, such as obviously going concern, but things like impairment assessments, and having a fresh look at, you know, the assumptions that underlie the value in use calculations, looking in a bit more detail at expected credit losses, as Taku mentioned earlier. So, you know, is there a deterioration in the recoverability of your trade receivables? So it's really inviting people to take a fresh look at the impact on business at the next reporting season, and ensuring that those disclosures, specific disclosures, are made across the financial statements. So a few bullet points here. I won't go through them in too much detail, but these ideas, concepts have been in place for a number of years now. It's, you know, consistency and linkage. This is really marrying up the front section messages to what is in the back section financial statements and the disclosures. The regulators are still seeing some discrepancy, contradiction, although it is an area that they have noted that has improved over time. Adequate disclosures, including explanations. So this is really focusing on those judgmental areas where, you know, that there's no right or wrong answer. It's subjective, it requires estimation. So it's really setting out the facts, the key assumptions, and how you have arrived at those specific assumptions. Complete and appropriate accounting policies. I think this is an area that has improved over time. People are certainly less boilerplate, more specific in their accounting policy disclosures, removing the unnecessary ones, and really just including the ones that are fundamental to the material areas of their financial statements. Final point here, specific to the entity and business risks faced. That goes back to what I said at the start, really documenting, explaining the key assumptions, how you've arrived at them, what the impact is, and then going on to set out the sensitivity analysis on the possible changes to those key assumptions. A couple of articles there which you can take away and read at your leisure. You've got the full annual review of corporate reporting that sets out in a lot more detail of all the points that we've touched upon this morning. And then down the bottom there, you've got the thematic reviews. So the FRC, the Financial Reporting Lab, does issue what they call thematic reviews on specific areas. They pick specific topics, goes into what they expect, some examples of good practice. So they're listed at the bottom there, and generally when they release a thematic review and what they expect, then the follow on is that the corporate reporting team will look at financial statements to make sure people have taken on board the messages and have applied them in those financial statements. So I'll leave you with those that you can read at your leisure. And next slide, please. I'll now pass across to Joseph.
So around the key matters for the 2023-2022 reports and accounts. Next slide, please, Jenna. I think the key message this morning has been around the uncertain times that we are currently living and the year has been. So the Russian invasion of Ukraine in February, that sent geopolitical shockwaves around the world. And then you have your economic uncertainty created by the ongoing COVID-19 pandemic. You have rising inflation, and Dave mentioned this slow economic growth, increased interest rates. You have supply chain issues, labor market, and so many changes and challenges that businesses are currently facing. And in this economic environment, especially with the heightened uncertainties, businesses really need to be agile and reassess the risks that are evolving. And those would need to be reflected in the strategy and reporting in this reporting season. So a couple of points to consider there. So it's around your principal risks and the changes in the business environment, the strategy and the business model, your going concern, your viability, your business performance and your positioning and financial reporting. And those things will filter into the impact of the items on the bottom of the screen there. So it's around your strategic report. It will really require additional emphasis and due care in drafting. So avoid unambiguous descriptions of your strategic report for risk facing the businesses and the impact on strategy, going concern, viability, and it should be cross-referenced to the relevant detail in the reports and the accounts. Dave touched on this, the impairment assessments and the disclosures. So your key assumptions, how those were determined, how they have changed, particularly given all the risks and the uncertainties. Those should be adequately disclosed and quantified. So that means assigning values to them and explaining how those assumptions have been determined with reference to future expectations and any changes from the prior year with quantified values included. Then you have significant judgments and estimates. So again, it's around the sources of the information, given that these are significant judgment areas, the sensitivities applied, how those have changed, and again, cross-referenced to the strategy. And then you have disclosures. So a couple of punchy bullet points there, but it's really about clear and concise disclosures. So omitting immaterial information, but really including the material information in sufficient detail so that a user is really able to understand what has transpired, how the entity has dealt with it, and how it's reflected in the annual report. There's also an issue around transparency. So really clear explanations as to the significant inflationary measures, for example, in your revenue supply, your leasing, your other financing contracts, and other effects in the financial statements. Your disclosure should also be understandable as well and specific to the entity. I think Dave touched on this as well. It's about avoiding boilerplate disclosures and really meeting the objectives of the relevant accounting standards and not just the specific disclosure requirements. So as a reminder there, additional information, so beyond the standards requirements, should be included where it's necessary to understand the impact of particular transactions, events, or circumstances. I think that one is a very important point to note. Your disclosure should also be complete and specific, well-balanced, integrated. Again, we speak about linkages, and an interesting one here is a reflection of material climate-related commitments, your risk and uncertainties in the financial statements, for example. And so this is really touching on some of the TCFD scenarios. And I think, yeah, we're in good hands with Joseph when he touches on this area. I'll now pass over back to Dave, who will talk through key considerations.
Thank you. Sorry, I wanted to pass across to Joseph a bit earlier then, and I forgot about this section. So I will pass across to Joseph after this slide. So apologies. Again, I think we've covered most of these areas before. I want to leave Joseph time to cover his areas. So these are just some of the areas in the forthcoming reporting season where the regulators are inviting you to reconsider the impact on not only the changes to the business model, but the economic environment more widely. And unsurprisingly, it's all about recoverability of inventories, the carrying value of non-financial assets, expected credit losses, deferred tax assets, contracts that may have now become onerous. So it's really just a list there, almost a reminder, depending on what's applicable to you, to go back, revisit, look at the value in use, look at the key assumptions, and reevaluate everything based on the current environment. I will now pass across to Joseph. Next slide, please, Jenna.
Thank you, Dave, and thank you, and I hope everyone found that useful. Today I'm going to talk to you on ESG reporting, really give you a flavour of it all. Obviously, I know a lot of people are discussing this. It's certainly one of the key topics, so I'm having discussions with my clients about what really I want to do through these slides, to give you an overview of what's kind of going on, why it's important, let you know who's falling into scope of the new requirements, in detail about what you need to disclose and where to disclose it, then really summing up so you've got some key takeaway points to hopefully consider as we move forward into the next financial reporting season. So the next slide that I've got is really just something just to really cover those global goals really of the sustainability, environmental and social governance and the aims. And obviously you can see here it's covering a whole broad range of really problems and things we face in society. But fundamentally, the aim of all of this is to make sure that hopefully, if all the companies pay attention to this, we get a more balanced society and also hopefully more balanced reporting as well. So some good aims there in terms of it, but obviously a long way to travel on the journey. So in terms of an overview, and next slide, please, Dina, thanks. I think everyone's known, but what people are interested in nowadays is changing, and people are becoming much more focused on an organisation's impact on the environment and society. It isn't purely focused on how a company is doing from a financial perspective. Investors, consumers, and employees as well make their choices nowadays in a whole series of other matters. And you know, just really showing probably how society is changing, and hopefully as well probably becoming more inclusive as well. But as a result of all of this, obviously there is need for more information on companies, and also in the data age as well, that means more information can be available to users to make their decisions. That's both in terms of what they're buying, what they're investing, and also who they're working with. So it's really important that companies embrace this ESG reporting. It's certainly something that we're seeing more and more in terms of the risks associated with it are being discussed, but also the opportunities as well, because for everything, yes, there may be an increased workload, but actually it is there for the benefit of the company. So you do need to make sure you're taking this on board, embracing it, and putting in place the appropriate action plans. And fundamentally, again, it's loads and loads of people are wanting this change and this increase in reporting from this. That's both by regulators, investors, but all the wider stakeholder groups as well. Now, obviously, for a certain period of time, some organisations have already got certain reporting lines in there. That's because of the regulation that previously existed. So there has been some energy and carbon reporting or greenhouse gas reporting that people have been doing for a period of time. But what the Task Force on Climate-Related Financial Disclosure is aiming to do is to bring together a lot of this reporting that has been in the domain for some time, make sure it's all kind of encompassed in one place, and as well make sure that it's actually it's a focus to become a material element of financial reporting. So it's really going to become central to that annual reporting that a company does. So moving on to the next slide, I will talk about really who's coming in to scope of the new requirements. So for 2021, last year end, the FCA required premium listed entities to do those TCFDs, and this is going to be extended to all standard listed entities for the 2022 year ends on a comply or explain basis. So for hopefully the aim is always on these things to the people want you to comply, but if you can't, you just need to be stating why and where you have not got that compliance for it. Asset managers, life insurers, and FCA regulated pension providers, they're all falling into scope for periods on or after the 1st of January 2022. And now quite a whole raft of entities will then fall into scope for periods commencing on or after the 6th of April 2022. So not necessarily for their 2022 year ends, but for next year. So therefore, you really do need to start giving thought about what's required. And the first one of those is the public interest entities, those PIEs. Now all UK companies are currently required to produce a non-financial information statement, which are those companies that have more than 500 employees and either have transferable securities admitted to trading on a UK regulated market, or banking companies or insurance companies. Also those UK companies with securities submitted onto AIM with more than 500 employees. And any UK registered companies not include any of the categories above, which have more than 500 employees and turnover of more than 500 million. And that's the same for large LLPs as well, and also traded and banking LLPs as well that have more than 500 employees. So some of the takeaways there, think about that 500 employee limit and 500 million turnover. So now move on to the next page. But also for the 2023 year ends, more AIM listed and large private companies will be falling into scope as well. And I think the key takeaway there is as you can see, over time, more and more companies are falling into scope, and therefore that not only increases the amount of companies that are coming into play, but it's also going to be indicative that that will be best practice, and it just would be assumed that that is what listed companies should be doing. So it's really important everyone kind of starts on that journey now, because I think it's just going to be an expectation that if you are listed and you're large, you need to comply with these standards. But I think one positive is that from 2024 onwards, we're expecting a more alignment in the sector, and hope those TCFD requirements will align up with International Sustainability Standards Board requirements to hopefully provide more and more conformity across the world, therefore more comparability, which I think is a positive on it, albeit I can imagine that will be quite a long journey. And only also, and this will probably be quite niche, something on the call, but if any of you are listed on an EU financial market, from January 2023, there are new technical standards applying there as well, and the Sustainable Finance Disclosures Regulation as well. So lots of things to bear in mind in terms of what's falling into scope. I think moving on to the next slide, this is very key. We've talked about who's falling into scope, but what do we need to do? What do we need to disclose on this? And the key thing really here is making sure you're going on that journey of development in terms of what you want to disclose and how you're going to disclose that. And on the next slide, I will touch upon where people are disclosing that. And I think really there are kind of 4 points here that people need to focus on. And I think the first 3 are probably I'm going to say easy, but probably the kind of the quicker ones to complete, whereas the last one is actually very, very complicated. The first one is in respect of governance and the need to establish roles and responsibility in that general governance framework. Now, obviously, people do have governance in place now with the various committees, the audit committees and so on and so forth. But what is being said on ESG is that ESG should cover all of these committees and it should be embedded throughout the organisation. So therefore, what we're seeing, and I think one of the recommendations as well, is that actually you set up kind of an ESG committee, you have a chair of ESG. So I want to really drive that role forward and make sure it's embedded in the organisation, that people are taking it seriously, and you have got those clear reporting channels throughout the organisation. The next point as well is making sure you've got clear goals in relation to ESG and what you're trying to achieve. And also as well, that's very clearly defined across the various categories. As it is mentioned frequently nowadays, you need to be transparent in what you're doing. So therefore, what we're seeing best practices that you're stating very clearly what your environmental strategies and goals are, what your social ones are, and what your governance are. So it's very clearly defined under all of the individual headings. Also, you need to do your risk management exercise in relation to this. I know people have been doing this for a long while on general business risks, but there's now the need to become much more focused on those climate and social risks that are there, but also as well putting out the opportunities that are there. This is, we are kind of in a changing world, and that isn't just about the risk of climate change as well. It's also about the opportunities that it brings to organisations and the change, therefore, that people are putting into their companies. So it's really important that you're pulling those out, you're labelling them clearly, and making sure they're easily understandable to users. Now, the next point is the point that I think is very difficult, and companies are having a lot of struggles with, because they're wanting, or the regulators want you to effectively establish and track metrics across these various pillars, and including certain metrics available for tracking some of the social and environmental initiatives or objectives that you are doing. But obviously this can be very difficult depending on the nature of your company. So for example, say if you're a clothing manufacturer, kind of where do you start some of these things? Are you looking for just from when the clothes come into your warehouse and into your shops, or should you be going all the way back and looking at the environmental impact that potentially the cotton farmer in the middle of Kazakhstan or wherever it is having on it? So, and all of those things need to be considered, because they're going to have a huge impact on your financials and what you are putting out there and reporting on. And again, one thing we are seeing is that we're having more and more inquiries, and this isn't just us, I know from speaking to the accounting firms, it's the same for them, more and more inquiries about us being able to provide some form of assurance over those metrics being published as well, to hope to give some more credence to them. So again, that's something you may want to factor into what you're thinking about doing going forward. However, I would note what often people are, if you're going to go down that route, you need to be very careful, you need to be very clear in terms of where your numbers are coming from. Obviously, people can only provide assurance when there is the relevant support there. And what we're finding as well is sometimes that when we go on these journeys, people would like to get assurance over a whole series of metrics, but actually there are just quite a few that actually can have the relevant support to provide that level of assurance on. So it's really important when you are coming up with those metrics that they are measurable and the relevant support can be obtained. Now, on to the next slide, which is really about where people are disclosing these. And at the moment, there are a variety of options. We can put them in that NFSI, which is a non-financial and sustainable information statement, in the strategic report, in the environmental and carbon report, and the sustainability report. And to be fair, we're kind of seeing a whole mix in terms of what people are doing. I quite like the sustainability report. That's simply because I think it's one quite neat package where all this can be put in place. And I think as well, users understand that quite clearly in terms of what it's about for it. But whatever is happening, you need to make sure that you've got alignment in both your financial and non-financial reports. You can't be saying one thing in your sustainability report or on your ESG reporting and be completely different in your financials. And so therefore there is the need to make sure those checks are being put in place. And also you need to make sure that when you're discussing and putting your climate related matters into and ESG matters into practice, you need to think about what potential impact there may be on your financial statements. For example, say if you're going down the carbon credit route and then maybe building assets as well for to hopefully offset some of your emissions, what's the impact on the financial statements there? Are you creating assets and things need to be brought on balance sheet? You need to really think quite carefully about this because it is much more complicated than you may first think. And again, also you need to be putting into place your disclosures as well regarding those standards. For example, say it could well be applicable that maybe you've got some assets that you've got to say that some of the judgments are linked to potentially some of your targets and metrics on environmental emissions and things. They need to be drawn out to making sure you're really getting that balanced and transparent position for your company's reporting. So now on to the next slide, which really is about the some of the takeaways. Overall, it is a very broad and complex subject, and it really does touch on every element of an organization. There's no easy solution, and you're going to have to spend a lot of time and resources to analyze what you're doing and also where you want to go and how you want to report it and those metrics that you want to put out into the public domain. But everyone is kind of getting on board from what we're seeing. Everyone's getting involved on this, but it's just going to be a very, very long journey on it. And I think one thing that is quite interesting is there's been a massive increase in terms of how many companies are identifying climate change as a core risk. It's now up to 74% of firms as well. And we don't necessarily think that's just because of some of the impacts that have happened over the last over the recent past, but also as well it's to identify the increasing difficulties that may be had in due to the TCFD requirements and the fact that at the moment, the way everything is based, it is not consistent and it's not necessarily 100% comparable as well. I think that will come over time, but it will take time for people to do that. But overall, as time goes on, we're going to be moving away from that comply or explain to really a full compliance standpoint on things. So companies do need to factor that into their long-term goals. And you're going to, as I've just touched upon before, probably you're going to have more detail and transparency in those metrics that you report. You're probably going to need to be doing those assurance statements as well and asking people to probably get that third party to sign off on them. That is going to include an incredible amount of work simply because you're going to have to collate all that source data to be able to support what you're putting in. And again, it's also going to be about showing improvement. I think at this initial stage, it's very much about showing what you are doing and how you're trying to improve things. Obviously, as time passes, people are going to want you to report back on what you've done, whether you're achieving your aims and whether you are actually improving in these areas. And I think the key thing here is to make sure that you're very transparent. As always, you've got to be balanced in what you're doing. If you haven't done as well, you're going to need to say you haven't done as well as you expected. But it's about getting the transparency. And I think particularly, it's always important to the financial statements, but this is going to be something people are going to be really coming down with you, like with a fine tooth comb on these points. You're going to really have to make sure you get this embedded throughout your organization early, and make sure you're not just kind of greenwashing and saying everything's fantastic and doing all these things because you think it sounds good. It's about being really truthful and being really transparent on what you're saying, and getting those linkages through as well to make sure we've got a full solid overview, and those accounts are really provided that linked up document that when someone's looking at all your reporting that you do, it links up and it shows you're a joined up organization with quite a clear set of strategies and goals. So thank you very much for that. That's appreciated. I hope you've found this webinar useful, and if you do have any questions, please feel free to type away in the Q&A widget. But thank you very much indeed, and thank you very much to our speakers.